Bill, good morning to you. If we may, let's start with the jobs report. 155,000. You know the numbers as well, I'm sure better than I do. 7.8% unemployment, some signs of wage growth, and perhaps a rebound in manufacturing. If you take that, add it to the ISM non-manufacturing report, what does it tell us about the economy?
It tells us that the economy is doing all right in the United States, a 2% plus or minus type of number, Eric. You know, I'd mentioned that the household survey, there are two different ones, the payroll and the household. You mentioned the payroll. The household survey only created 25,000 jobs, so it's a little bit weaker. And the unemployment rate, as you mentioned, at 7.8%, a little bit higher, I suppose. So the economy is doing all right, but it faces structural headwinds, as we've suggested over the past 6 to 12 months, that will be difficult to move forward.
Bill, even if we are seeing this wage growth, the payroll tax hasn't hit Americans yet. When and if it does, what is that going to do to consumer spending, retail sales, corporate earnings? Can't we see companies really get hit by it?
Well, we can, and we've talked about that at PIMCO in terms of the investment committee that we have on a daily basis. You know, we think that this fiscal drag that you speak to, Stephanie, will lessen U.S. economic growth by 1.5% relative to what it would have been. Now, let's you know, take the optimistic side and speak to housing and natural gas and fracking and all of the positives that we see in terms of a forward thrust, but suggest that that would have been a 3% number for the year of 2013. We're now looking at a 1.5% number as fiscal drag comes into play. We see that in Euroland, we see that elsewhere. You know, it's simply a question of too much debt and delevering being reflected in the statement for the U.S. fiscal budget.
Bill, you may have heard our colleague Scarlett Fu inform us that Treasuries are the world's worst performing sovereign bond market so far this year. I know that doesn't surprise you given your views. How much longer do you think this sell-off can go?
Well, we look at a number of areas in terms of the curve on Treasuries, Eric. The 30-year, you know, we're fearful of simply because it reflects the potential in the out years for higher inflation. What will that be? You know, to our way of thinking, 2.5% to 3%. That's actually what the Fed is targeting. So the long bond, to our way of thinking, is certainly not an attractive asset. The 5-year, however, which is more benched on what is the Fed doing on quantitative easing and the policy rate, you know, at 83 basis points, you know, is that a super duper deal? You know, certainly not. But when you add what we call roll down, it produces a 1.5% to 2% return on a safe asset. So we like 5s, we don't like 30s.
How about 10s? That's the one that so many people look at when they think of a benchmark for the Treasury market. Bill, do you think it's possible that we might take out 240 on the 10-year, the level we hit last spring?
No, I don't. It's possible only if the Fed abandons quantitative easing, as the minutes hinted at, you know, yesterday in terms of the disclosure. We don't think that's the case. You know, there's perhaps 6 or 7 discussants in terms of the Fed meeting that suggested that 2013 was the limit. There are concerns in terms of the balance sheet, but let's suggest as well that some of the more dovish members of the Fed, Rosengren, Evans, will become voting members in 2013, and so they join what we call a Three Musketeer dovish group led by, of course, Yellen, Bernanke, and Dudley.
We were talking sovereign bonds in Europe. German Bunds, for example, had a standout year in 2012, in large part because of all the sovereign issues facing Europe. Given what a great year they had last year and that things seem to be somewhat stable, is it time to reverse the trade and go short Bunds?
Well, we're not short Bunds, but we're underweight Bunds, Stephanie, and overweight Italy and at the margin Spain. You know, to a certain extent, that thesis, that position is dependent upon some sort of stability in Euroland and some sort of effort on the part of the ECB to stabilize the bond markets. Whether that will occur or not, whether Spain will request or Italy will request in terms of what is officially known as the OMT, we're not sure. But we certainly think that Germany is less attractive than Italy and Spain.
Bill, bringing it back here to the United States, you shared with us a few minutes ago your views on treasuries. You like the short end, don't really like the long end. What about other options in the U.S. bond market, specifically munis? We know that you like New York State munis, for example, from the Total Return Fund, but we only have the data as of the third quarter. Is that something that you're still into?
Well, it's something that we were, Eric, because those yields were 40 to 50 basis points higher than respective treasuries, and they were tax-free. You know, at this point going forward, although we didn't see any threatening weather from the standpoint of the recent budget agreement, there's the possibility that muni withholding rates will be subject to future legislation. So, you know, we'd be a little bit cautious. We're holding on to our positions, but muni rates are in this cloud of will they or won't they be taxed in terms of withholding. So we'll take a cautious stance.
And you believe that that's a real possibility? It sounds like it to me. There are many people, particularly those with a big vested interest in the muni market, who dismiss it and say that Congress would never do that.
Well, we think that the odds are that they won't do that. Let's put that forward. But, you know, there's still a decent chance. What is that chance? 10, 20 to 30% that something will take place. I mean, we've been surprised before in terms of the payroll tax, as we were, or most of us were last week. And so, you know, Congress at this point can do lots of things that are surprising. So we'll be relatively cautious on munis. We won't be selling them, but loading up on more New York munis, probably not.
Bill, I want to talk equities and corporate debt for a moment. So many of the stocks in investment-grade companies are offering higher dividend yields than the corporate bonds do. When are we going to start to see a shift out of bonds, out of corporate bonds, into those same credits, but on the equity side?
Oh, that is the great perplexing question. You know, it's what I referred to in terms of the cult of equity. In other words, the fear of equity returns and volatility going forward. We've had Lehman in 2008. We've had the cloud in terms of fast trading. You know, we've had regulatory and banking issues. And, you know, to a certain extent, the public is discouraged from owning stocks. It doesn't mean that PIMCO doesn't think that stocks are more attractive than bonds. We do. We share your thesis in terms of the higher yields and the potentially higher returns, but whether the public will take that bait, we're not so sure. They're getting older demographically. The boomers are moving into the 60s, and they want fixed as opposed to equity. And so, you know, we'll simply have to see and observe. But PIMCO is not suggesting that the public, you know, dump stocks and move into bonds. We're simply observing along with the rest of us.
But are we ignoring the fact that bonds are facing inflation risk? Yields are getting tighter and tighter, so the return on these high yield and corporate bonds are getting smaller and smaller. Could one say we are facing a credit bubble and it simply doesn't make sense to be in this market anymore?
I think we're facing bubbles almost everywhere, Stephanie. We're facing many bubbles in equity prices. We're facing many bubbles in high-yield bonds and bond markets around the world, simply because the central banks have been buying trillions of dollars worth of these assets, and the money has then flowed out into what we call the outer circles of risk, stocks, high yield, etc. So there are many bubbles everywhere that investors should be concerned about. What's the relief from that? What do they do because of that? Well, they take some risk, and they go for some of those attractive returns on stocks, which we think are like 5% a year going forward. But, you know, they also become cautious and start to move into the cash category and give up some of that potential return simply in terms of the protection of principal going forward.
Bill, before we run out of time, I want to ask you a question about fiscal policy and the looming debate over the debt ceiling, specifically one of the more unusual ideas to come out of Washington. Maybe it came from somewhere else, in fact. This idea that the Treasury Department legally could issue currency in the form of platinum, perhaps even $1 trillion coin, and do an end run around the Republican Party and prevent the debate or the war from starting in the first place. Do you give any credence to it, this platinum option, so to speak?
I don't. I think they can. You know, it's not a novel idea. It's something that's been advanced over the past several years. But, you know, whether Ben Bernanke and the Treasury in combination would jeopardize their standing with Congress by this type of end run, no. We don't give it much credence. What is happening at the moment, although it's subject to the debt ceiling, is that the Fed is buying everything basically that the Treasury can issue. And so we have this conglomeration of fiscal and monetary policy that is happening not just in the United States but in Euroland and increasingly in Japan. So the debt ceiling, it will be interesting to see what happens over the next few months, but a platinum coin, not the solution.
Phil, I want to go back to fixed income for a moment. When I look at 2012 performance, mortgages was clearly the sweet spot to be. All you needed to be was long, and it was a bang-up year. Is that trade over, or is there still money to be made in the securitized products in 2013?
Well, the Fed's buying $45 billion a month, Stephanie, and so is that a safe trade? You know, it's probably relatively safe, but it's over in terms of the capital appreciation. I mean, basically, a 30-year 3% mortgage yields only 2 to 2.5%. So, but you know, the real kick, as you mentioned, in 2012 is over, as perhaps is the real kick in corporate bonds. We took advantage of that in 2012. Mark Kiesel and his group were just named Morningstar Managers of the Year because of that. And so, you know, we'll be looking to some corporates, we'll be looking to mortgages, but the total return from bond portfolios in 2013, to our way of thinking, are a 3 to 4% number, and it's not a 10 to 11% number like the total return fund garnered.